So here's this beautiful Class A apartment, brand new apartment with amenities, right? It's got a hot tub, a sauna, a state-of-the-art fitness center, meditation rooms. What? And it can be really sexy to want to invest in Class A apartments or these brand new apartments, but I never do it for one simple reason, and most people don't see this. I see it as the highest risk deal within real estate. And a lot of people will disagree with me. I've got a lot of friends that do Class A apartments. I'm not trying to offend anybody, but I don't do it for one simple reason. I focus on value add deals, but I'm going to explain it in 3 simple steps. Let's jump into it. Okay, first of all, before we get started, if you haven't joined our investment club, we're doing some awesome deals like this one behind me over here. We're regularly doing deals. You can find them at bronsonequity.com. We have to have a relationship with you to share most of these deals. So go to bronsonequity.com, join our investment club. We'd love to start a relationship with you to be able to share about our deals, which are some awesome deals. So let's talk about Class A deals. Now, again, I have good friends that do this, not trying to offend or hurt anybody's feelings, but I look at them is that it's the high risk of being in a Class A deal. So Class A typically means it was built within the last 5-10 years, either a brand new apartment or very, very new. So what happens in a recession? So as you can see, I live in Pasadena, California. You can see this apartment here. This one has already come down a little bit, but it's $44.10 a month for a 2-bedroom apartment. And what happens in a recession is typically Class A or brand new apartments, people tend to move down to Class B. Well, what does Class B mean? What is Class C? What is this stuff, right? Class B is typically, it's the age of the property. It's usually 10 to 20 years old or so. And then, if it's over 20 to 30 years old or more, it's usually Class C. And there's some that are really rough that are Class D, which we don't really do anything with. But people tend to move down during recession. So obviously we're kind of moving into recession. What does that look like? What does that mean? So a lot of groups, why do people do Class A, right? Why do investors, why do investment groups do it? Well, the reason people do it, and the reason a lot of groups that do it, they're called REITs, real estate investment trusts, or even really large syndicators such as Grant Cardone. They'll do this because they have too much money. And you say, well, what do you mean they have too much money? Well, when you can raise $500 million, you can't go into a B or C property and do this value add or do these renovations and try to increase the value of rents and increase the value of property over time. It's just too much money. I'm going to get into the value add strategy and how it works in a little bit. But again, what it does, it forces you to go in the nicest, newest properties, which there is a plus side to that, right? The plus side is you get a lot of these amenities. As an operator or an owner, you don't really have to do as many repairs. So there are some positives to it. But again, Warren Buffett has a saying. He says, rule number 1 is don't lose money. And rule number 2 is don't forget about rule number 1. So as you can see, I'm a big fan of Warren Buffett. And one thing he looks at is where is the margin of safety? He says the 3 most important words in investing are margin of safety. So when you look at that means you have to look at your downside, right? Don't lose money. Where's the margin of safety? Well, in Class A, there really isn't any. There's not as much margin of safety. And what I mean by that is that, typically in Class A, we'll hope for brand new apartments, we're hoping for 7 to 10% returns, right? But what we're really counting on is that the market will continue to appreciate. Well, what happens if there's a recession? What happens if rents go down? What happens if you can't get the $4,100 a month for that 2-bedroom that we were getting before and it's only $3,500 or $3,000? Well, it dramatically decreases the amount of returns to maybe even you're actually losing money. But there's more downside I see in these deals than there is upside unless everything goes right. But there is, thank God, another way. And it's called value add multifamily. It has the idea that you're renovating, you're adding value, you're making things better. And that's what allows you to see a pop in the value of the property, which dramatically increases your return. So check out this property that we're doing in Jacksonville, Florida. We've got about 1,500 units there. And really this is how multifamily deals are different. So this particular deal, we bought it, average rents were around $1,000. And this is after putting in about a $6,500 renovation. So we come in, we do floors, we do countertops, we do some appliances, we paint, we look at the bathroom, we do all this stuff. We can see an increase in the rents by $566 to the average rent of around $1,566. So that's a 57% upside in the rents. Now, single family is very different than multifamily. Single family is that you sell your house, it's worth what a property across the street or across the block or a mile away is worth. In multifamily, it's all based on income. So if you can increase the income by 57%, you're increasing the value by around 57%. Now, it's not always a one for one. There's some other things that they do, but in general, that's what you're doing. So if we can renovate 80% of these 227 units in this deal over the next couple of years, we know we're going to see a big increase in the value. Now, this is called it's called forced appreciation. There's two types of appreciation. One is market appreciation, which you do see in Class A, and then you also see it in these type of Class B or C apartments that we're doing. But what you're really looking at is the forced appreciation, right? We're at 1,000. We want to get to 1,566. What happens is, even if there's a recession and those rents are not 1,566 or they're 1,450, we've got this whole margin here that we're still doing really well. We're still making a lot of money on the increase that we have. And if things keep going up, we're going to do even better than that. So it brings, instead of returns being around 7 to 10% per year of what we see in Class A or newer apartments, we see typically projections around 14 to 16% conservatively. So it's much, much higher, right? So you get basically the cash flow that you get in the newer deal, but you also get this big pop, which allows you to see, closer to 14 to 16%. Now, if you're getting a 14 to 16% return, we're typically seeing, that's basically that type of return will double your money in around 5, 6 years, 5, 6, 7 years, which is amazing. Versus it might take 10 or 11 or 12 years at a lower or an interest a increase of 7 to 10% per year. So obviously you want to have downside protection. This allows for downside protection, but it really allows you to make sure that you're maximizing what you're able to get on a deal. Now, the question is, well, what can go wrong in this, or what's the, why wouldn't you hold this kind of deal forever, right? Warren Buffett also says the best holding period of an investment is forever. So why would you sell, right? But once you see that pop, right, we've done all this value, we've seen all this increase, typically every year you hold it longer than that, your returns per year actually go down, right? Because you're not seeing this big pop and increase in the rent. So that's why we typically hold them for 3 to 5 years, sometimes a little bit longer or shorter, but in general, that's kind of what we will generally do. So just as a quick summary, Class A can go well. Class A apartments, brand new apartments can go well when things are going well. But just remember, you're not going to live there yourself to enjoy the sauna and the fitness center and all this, the beautiful amenities. Typically, you get paid very well to do workforce housing and to really add value. So look at that and look about how you can increase the value over time. Greater margin of safety does add greater value in deals. I want to share this quote for you. It's a pretty short quote, but it comes from Henry Ford. He says, if it doesn't add value, it's waste, right? So if you're not adding value to what you're doing, whether it's a conversation, whether it's your neighbor, in their life, you're encouraging someone, or even in an apartment, if you're not adding value, you're just simply there. And so I would look at everything you do as, what is some way that you can add value? So if you're interested in looking at this panel we do these amazing panels once a month. This one was about what a great multifamily deal looks like. 3 great operators talked about it. But anyway, I want to encourage you, if you haven't joined our investment club, please check out the link below, bronsonequity.com, click the join button. We'll start a relationship with you. We've got some amazing stuff in the pipeline right now. Really excited about it. But anyway, thanks for taking the time to educate yourself. I would love to hear from you. Let me know what impacted you of this video. If you love Class A, if you hate Class A, if you think I'm terrible because I'm only promoting value add deals, would love to see what you think in the comments below. Look forward to seeing you on the next video.